In 2024, China made waves in the global financial markets by dumping U.S. Treasuries and boosting its gold reserves. This decision is not just a financial maneuver, but a strategic, geopolitical move. The world watched in awe as China shifted its economic policies dramatically. Why would a nation like China, with deep financial ties to the U.S., make such a bold move? The shift to gold signifies more than just a change in investment strategy. It reflects a broader vision for financial independence and stability. The repercussions of this decision are far-reaching, impacting economies worldwide. China's move is both a response to and a catalyst for changing global dynamics. To fully grasp the significance of this shift, we must first understand the historical financial relationship between China and the U.S. Since the late 20th century, China and the U.S. have been closely linked through financial ties. China's rapid economic growth was fueled in part by exporting goods to the U.S. In return, China bought large amounts of U.S. Treasuries, effectively lending money to the United States. This relationship was mutually beneficial, bolstering the economies of both nations. The U.S. Treasuries served as a safe investment for China's vast foreign exchange reserves. By holding U.S. debt, China ensured a steady return on investment. For the U.S., this meant a reliable source of funding for government spending. This symbiotic relationship contributed to the stability of the global financial system. However, this financial interdependence also made China vulnerable to shifts in U.S. economic policy. Events such as the 2008 financial crisis highlighted the risks of over-reliance on U.S. Treasuries. In the years following the crisis, China began to diversify its investments. This gradual shift set the stage for the dramatic move in 2024. The reasons behind China's shift to gold are multifaceted. Firstly, gold is seen as a stable store of value, especially during times of economic uncertainty. Unlike fiat currencies, gold's value does not depend on any single government or economic system. This makes it an attractive option for diversifying reserves. Secondly, China's move can be viewed as a response to increasing geopolitical tensions. Relations between the U.S. and China have been strained in recent years, with trade wars and political disagreements escalating. By reducing its reliance on U.S. Treasuries, China is hedging against potential economic sanctions or other punitive measures by the U.S. Another driving factor is the desire for greater financial sovereignty. Holding U.S. Treasuries ties China's financial fate to the policies of the U.S. Federal Reserve. By increasing its gold reserves, China aims to exert more control over its monetary policy and economic future. Furthermore, China is positioning itself to influence the global financial system. China's shift from U.S. Treasuries to gold has significant implications for global economies. For one, it could lead to increased volatility in the U.S. Treasury market. As China sells off its holdings, the supply of U.S. Treasuries increases, potentially driving down prices and increasing yields. This can result in higher borrowing costs for the U.S. government. Other countries may follow China's lead, diversifying their reserves away from U.S. Treasuries. This trend could weaken the U.S. dollar's dominance in the global financial system. For gold-producing countries, this shift could be beneficial. Increased demand for gold will likely drive up prices, benefiting economies that rely on gold mining. Conversely, countries heavily invested in U.S. Treasuries may face challenges as the value of their holdings fluctuates. The move also signals a potential shift in global economic power. The U.S. economy is likely to face several challenges as a result of China's divestment from Treasuries. Increased yields on U.S. Treasuries can raise borrowing costs for the government, leading to higher interest rates. This, in turn, can slow economic growth by making loans more expensive for businesses and consumers. The U.S. dollar may also experience increased volatility. As China and potentially other countries reduce their holdings of U.S. assets, the demand for dollars could decrease. This may lead to a depreciation of the dollar, affecting international trade and investment. Exporters may benefit from a weaker dollar, but importers and consumers could face higher prices. Moreover, the shift underscores the necessity for the U.S. to reconsider its economic policies and international relations. The dependency on foreign investment to fund government spending is a potential vulnerability. This situation might prompt discussions on fiscal reforms and strategies to reduce reliance on foreign capital. The long-term effects of China's move are still unfolding, but it is clear that global economic stability is at a crucial juncture. This shift represents a significant reconfiguration of financial power dynamics. The move away from U.S. Treasuries and towards gold could herald a new era of economic policies and alliances. For China, this strategy may enhance its financial resilience and global influence. By reducing dependence on U.S. assets, China is better positioned to navigate economic uncertainties. However, this approach also carries risks, including potential retaliations and market volatility. For the rest of the world, adaptability will be key. Countries must reconsider their own reserve strategies and economic policies in response to these shifts. Ultimately, the future of global economic stability will depend on how nations respond to these changes.